PayPal is on a massive drawdown from its all-time high, and it's one of those stocks that many investors believe is at great value, but it's something they continue to hammer on nearly every single month, and it's been a long time since this company has really produced any significant gain. There are many reasons why you can see investors on both sides of the fence. On one hand, it looks to be trading at an incredible valuation for the metrics we'll run through, and on the other hand, there are significant reasons why this could be one to avoid. If we were to look at analysts, well, this year many of them have started to cut their price target, but it still does, given the share price today, show that this could have some significant value. Now we're going to run it through our valuation ultimately and discuss how this could be a 2x and fairly soon, but it's also important to understand some of the risks. Now, year to date, the company is down 21%. They've lost more than 1/5 of their market cap. Over the last year, still nothing too great. And over the last 5 years, down 64%. Over the last 10, whilst we have seen a significant drop, you would have massively underperformed the S&P. In fact, if we look at their all-time highs, you'd have to go back more than 4 years ago today, where it was trading over $300, and currently it's trading towards the lower end of the 52-week range. We get one buy rating from Wall Street, which is very weak at 3.66, and a fairly respectable one from Seeking Alpha, who give this a 4.23 out of 5. Now on evaluation, quite interesting, we get a D+, but it will depend as an investor which metric you like to look at. On a forward P, it is 13, which is actually above the sector at 11.4, but in terms of the price you're paying, it is a premium around 15%, but actually at a massive discount to their own 5-year average. We're talking 51%. Now you may think that is good, but we will also have to compare their performance against the last 5 years to really understand if the business is in a better position, are they growing at a faster rate, or maybe this discount is in fact justified. The other metric we'd like to look at is one that incorporates growth, the PEG on a forward basis, 1.33, meaning you're paying a 12% premium to the sector median, and against their own 5-year, another discount slightly smaller at the 20% level. And just in their latest earnings, they increased their profit forecast for the full year. If we take a look at their performance, well, top line itself was up 5% on a year-on-year basis. Not the greatest. Perhaps this is one now that cannot be talked about in terms of a growth company. And whilst we see efficiencies to their gross, operating and bottom line, we're only talking 1%. So fairly trivial, but nonetheless, at least we're seeing some improvements. And their active accounts, again, we are seeing growth, but on a very low single-digit basis, sitting at 2%, of which they now have 438 million active accounts. In terms of the guidance that they raise, we can see earnings per share expected to be 11 to 14% growth for 2025. Quite a significant jump from April 25, where it was at 6 to 10%. Most of the other metrics remaining pretty much similar. And one thing we want to point out, as it will become the basis of our valuation on a DCF process, expected 6 to 7 billion of free cash flow in 2025. One of their growth drivers, though, moving forwards is the pay with Venmo, where they've seen 45% growth, as well as the BNPL, the buy now, pay later. We're talking around 20%. So yes, growth, as we'll highlight, has been lacking, but it looks like the CEO believes they will be able to find ways to get back up to the double-digit rate investors want to see. And always great when we look at the earnings slide to see green across the board. In the last 4 quarters, PayPal have outperformed on every single one, 100% track record, and whilst they are expecting growth to the EPS over the next 4, nothing too glamorous. We're talking around the mid to upper single digit, although next quarter, very, very minimal. So look, if they can hit their estimate for the next full year, forward P for PayPal will come down to just below 12. And we got some bullish news for the company. They've entered into a multi-year partnership with Google to integrate PayPal checkout, Hyperwallet, as well as payout right across Google products. And they're going to use Google's AI to enhance their services and security. So ultimately could drive a lot more volume through Google's huge user base, but also potential pressure on their margins depending on how the pricing or the take rate is negotiated, and they now currently have a near 10% buyback yield. So what this effectively applies is that the company has repurchased around 10% of their total market cap over the last year, meaning it's increasing each shareholder's ownership percentage in the company without them buying more stock. So effectively, owning PayPal right now is like getting a 10% yield, but instead of being paid in cash, you're being paid in ownership, and management are really driving on this. They're really focusing. If we just look at the free cash flow they're producing every single year, the majority, in fact even sometimes a lot more, they're spending it all on share buybacks, and just in the last 5 years alone, they've reduced their total shares outstanding by 19%, and if they continue this trend, well, over the next 5 years, they will have bought back around 40 to 50% of those total shares outstanding, and just look at that dip. Management are really focused on share buybacks. Now, this is also quite an important graph where we're looking at the total payment volume, the TPV, as well as the transaction take rate. We're seeing the TPV increase, so obviously a positive sign. More volume, meaning more usage, more customers, more merchants, more transactions, and it's telling us that PayPal is growing its business, gaining share, or in fact riding market tailwinds, e-commerce growth, a digital payment spillover, and reflecting a strength in demand as well as their platform scale. However, on the other end, we are seeing the take rate decrease, which is the revenue PayPal are making per dollar of the TPV that they're processing. Remember, this is after costs or any fees they pass on, any discounts, and if this continues to decline, it means even though TPV is rising, their revenue per unit of volume is shrinking, and this can be for many reasons: competitive pressure pushing their fees down, any changes in the kinds of transactions, as well as shifting their mix towards lower margin business segments, whether that's unbranded processing, bigger merchants who get negotiated discounts. So just bear in mind, if this continues to decline, we will be seeing their margins being squeezed and could ultimately slow revenue growth even if volume continues to climb. And another way to look at the company, we are seeing the earnings per share over time increase. We're in fact seeing the free cash flow, whilst a little bit inconsistent, following that same trend, yet we're seeing, and maybe most importantly, especially for value investors, the valuation of the company really decreasing in what we could argue is a potential strong value play. Now, their growth does come in at a C. We're talking 4% last year, which is actually pretty much in line with inflation, 6% this year, not the greatest, not too far off the sector as well. The main issue here is, though, historically, they were growing at a double-digit rate, and on top of that, remember, they were valued higher, so you can argue it actually makes sense why the company's trading at a discount to their own 5-year. Earnings per share also backing this up, projected 10%, not far off the sector, but we can note over the last 5 years, it was higher, just above 15. Now, profitability also important at an A-, 42% gross margin, well below the sector at 60%, below their own 5-year, so we are in fact seeing here deficiencies to their margin. In fact, the bottom line net income at 14%, quite a lot of disparity against the sector at 23%, but not too dissimilar from their own 5-year average. And the amount of cash the company generates, $6 billion on a trailing 12-month. Yes, it is above the sector. Only thing we would say, we would have expected in comparison to the 5-year average, which sits at $6 billion, a bit more of a larger jump. So it does tell us, in terms of the cash they're producing, not that much different than over the last 5 years. We would have ideally liked to have seen quite a bit of growth here. And in terms of some of their underlying metrics, like the free cash flow per share, yes, consistent growth over the longer term is what we want. Not massively consistent, but great to see the continuation expected over the next 12 months. But one of the things that may concern you is their growth from 2015 to 2021, double digit, and since then it's only been decreasing 4% on a trailing 12 month. They expect around 5 to 6 for 2025. So definitely something for serious consideration. Yes, there are good points about the company, but clearly there are also reasons why this company is valued quite low. Now, revenue has been increasing. We're talking 3x over the last 10 years. But as just highlighted above, we are seeing a slowdown. Shares outstanding, we have already discussed this, something we expect them to continue. And like we said, it may not be that long before we see quite a large chunk of those shares being bought back. We're talking in just a number of years. Now, ROIC, great to see it increase, great to see it above the 10% minimum we want to see for every company, just to give us faith management are able to effectively allocate their capital. Margins, Now we want to see around 16% at a bare minimum, which is what we see, but no real efficiencies, which is a little bit disappointing, but free cash flow does make up for that. We want a minimum 5%, looking very strong, but again, understand quite a bit of inconsistencies in the company. There is no real growth moving forwards. Some years they do perform a lot better than others. Now, net debt to EBITDA, as always, a very important metric, does highlight the number of years it would take PayPal to pay off all of their debt net of cash on hand. We want to see a maximum of 3, so this is actually pretty decent, 0.3 on a trailing 12 month, 0.29, so no worries here whatsoever. But one worry is their performance. If we compare them against others in the sector, we can see Fiserv, Aiden, Block, as well as a few others. If we look at their performance in the last year, they're down 13%. Actually tells us the industry as a whole, for the large part, hasn't been that good at all, so maybe not one that is fully for PayPal to take the blame. But when we zoom out to the last 5 years, we see they're down 64%. Again, quite a lot are in fact down, but they are once again the worst performing in the period. Over the last 10 years, a lot better, but still not the greatest. You kind of want to see a better performance than 105% in this period, but remember, past performance is not an indicator of how they'll perform in the future, and the answer is pretty clear. But just keeping the consistency against the S&P, massive underperformance in just the last 12 months, where the S&P is positive, PayPal is negative. The same actually in the last 5 years, negative 64, S&P up 103, and over the last 10, even with the positive triple digit from PayPal, they've still significantly underperformed, where the S&P has been up 242%. Now, institutions currently hold 68% of the company, where they sold $6 billion in just the last year. They bought twice as much in the same time period, whilst buying around 50% more in the most recent quarter, $2.2 billion versus $1.4 billion selling. Interesting to note, maybe we will see this trend continue, as the share price could look very attractive to value investors, but it's one that with the low insider ownership at 0.08%, we don't see any insider buying, we just get insider selling, where we note around $2 million, and that is 5 individuals in this period. In fact, in the most recent quarter, 1 million selling. In the previous quarter, near enough around $900,000. Likewise, if we look at super investors, well, around 8 of them hold PayPal in their portfolio. We had 1 new buy in the period, quite significant, making around 16% of their total portfolio, but quite interesting to see here, 2 of them fully selling out. Pat Dorsey selling, which is around 6% of his portfolio, actually selling more shares than this latest buy, but just something worth highlighting. And before we jump into our valuation, we want to point out revenue over the long term, whilst has been slowing down, has increased, as we said, threefold from 9 billion to just over 31. But as always, we want to understand bottom line net income. Is there a trend? Can we see it consistent with the top line revenue? Now, the answer is more often than not yes, but over the last few years, it has remained fairly flat. Little bit of a worry. Yes, it's gone from 1 billion 10 years ago to now at 4, but if we just look, in fact, at the last 5 years, 4.2 billion, 4.2 billion, a drop to 2.4, back to 4.2, and near 4.2. That is a little bit of a worry. As a shareholder, you do want to see not just revenue increase, not just margin improvement, but also increases to the bottom line net income, as that is typically where shareholders will see a return in the form of an increase to the share price. And the other thing is a quick health check, total cash versus total debt. Now it's increased from 3 billion threefold to now sitting at 10. But as always, one number here, isolation, will give nothing away. So we compare it to their total debt numerically and directionally, which in fact has only continued to climb over the period, going from 0 in 2015, now sitting at 12 billion. Now cash isn't too far off, which is why on the net debt to EBITDA, we had around 0.3. No worries at the moment, but just something to consider, especially if we do see debt continue to climb. Now, before we jump into our valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's gone in the market over the last few days, where you'll also be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation, where our intrinsic price gets to $118 derived from the DCF model. Now, first thing we will highlight is that for 2025, remember they said around 6 to 7 billion. So for the starting point, we have gone slap bang in the middle. And the average growth rate, whilst 26%, we have seen the trend continue to decrease. So we have gone for what we would say a very, very conservative 2%. Now look, we have a low, medium, and high. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for PayPal or any others. But 2% growth rate and the discount rate gives us the present value of future free cash flow terminal price, add together with a cash, subtract total debt, giving us the equity value, dividing by shares outstanding, $118, indicating 64% upside. Now you might sit there and say that is way too conservative. Well look, if you believe that at 4%, $137, 100% upside, that is a double from the current price using the middle rate, which is typically what we like to look at. And for consistency and transparency at the 6% point, $152, more than a double at $127. Now the fascinating thing is, if we were to use a reverse DCF highlighting what is baked in right now to the market price of $67, well, it's a decrease to the future free cash flow of 7% year on year. So pretty interesting to see what the market is highlighting. It does believe that PayPal will not see any growth to the free cash flow, in fact a decline. But let's use the 2% because we're not done there. We want to see what is the margin of safety on that. And remember, on the channel, 10% is the starting point. We execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy at $106, but really the major thing here is that based on this 2% growth rate, you're getting a 43% margin of safety. Is that one to consider? Yes, it doesn't pay a dividend, but they return excess cash to investor pockets through those share buybacks. Instead of paying you an amount every quarter, every month, or every year, they're giving you larger ownership control of the company. Wall Street themselves, many different price targets, on average $85, that is 27% upside. So let us know your views. Do you believe PayPal is a buy, hold, or in fact one of those stocks that is a trap and to avoid? Now we can also show you, for example, if you want the middle rate of 4%, margin of safety slap bang there at 50%, and for those that believe it's going to be even higher, well, we'll highlight here at 6%, clearly larger, and that's correct at 56%. Now what we'll do is something a little bit different. If you believe there will be no growth to the future free cash flow at 0%, intrinsically we get to $104. That is an MOS of 35%. Again, we can keep going if you believe that actually let's be conservative, but let's use a declining rate. That is what the market believes at -7. Well, -2, $91, indicating 27% upside. If you want to go another step and do -4%, well, $80, which isn't too far off where Wall Street see this into the next year, we're talking a 17% margin of safety. Now we want to be reasonable but also conservative, and at the 2% growth rate, we are seeing a 43% margin of safety. Doesn't mean it is a massive buy right now. You need to consider a lot of different things. Also, some of their competitors, something we haven't touched upon today but have in a previous episode, but give us your overall views. Is PayPal a must buy? Is it one to avoid? Or maybe one a bit indifferent and you do see it as a hold? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.